In the last video, I introduced the concept of technical analysis. When it comes to technical analysis, a trader that is learning under our method must master 3 concepts. The first is market structure. In this video, I will explain what market structure is and how it helps us anticipate the direction of the market. A strong understanding of market structure allows us to use past history to determine the potential future direction of a trade. Knowing the direction that is most probable is the first step to placing winning trades that have good return. First, let's talk about how the market moves. The market moves in waves. If you open up a chart and you're looking at a pair or instrument, you'll see that while the market may be moving up, you'll see upward and downward movements. So as price is moving up, you'll see it moves up and then goes back down, then moves up and then goes back down, and then moves up. Also, as price moves down, overall, price is moving down here. You'll see down movement, up movement, down movement, and up movements. So price doesn't go in a straight up line or straight diagonally. It moves in a wave. So as a new trader, when you open up the chart without any structured knowledge or a perspective of how to see and how to understand how price is moving, buying and selling is happening, you may be confused. So the first thing that we're going to discuss when it comes to technical analysis is how to read market structure. So market structure provides us with a way of understanding the movements of the price movements up and down. And there are 3 types of markets when it comes to market structure. There are trending markets, meaning that the market is trending upward or trending downward. There's ranging markets. The market is moving sideways. So it's not going up or down. It's just moving sideways. It's trending sideways. And then you have the choppy market where there isn't a clear direction. It's not moving up or down. And also it's not ranging between 2 boundaries. There isn't a lot of volume. There isn't a lot of movement up or down. So in this video, we're going to talk about the types of trends. We'll talk about trading the ranges, and we'll talk about why we should stay out of the choppy market. So when it comes to the trending market, there are 2 types. There's the uptrend market and the downtrend market. First, the direction of the market. When we're trying to identify our edge, first we need to know the direction of the market. Where are the professional traders taking the market? Where are the institutions taking the market? And we want to swim with the big fish. We want to go in the direction of the big fish, of the big institutions and the professional traders. So an uptrend is a series of what is called higher highs and higher lows. So here at this point, this is a high. It comes back to create a higher low, higher high, higher low, higher high, higher low, higher high. This is an uptrend. And the uptrend, it looks like this in theory. This is an abstract picture of it, but this is an actual picture from US 30 here. So you have, from GBP JPY. So here you have a high, then you have a higher low. You have a high, higher low, higher high, higher low, higher high, higher low. So this is what an uptrend looks like, okay? Now, there's something that's important about the uptrend is that when the market is trending, you'll have 2 types of movement. You have what is called the impulse movement. That's the movement up here in an uptrend. And then you have what is called the retrace, okay, or the correction. So as the price is going up, the professional traders, they'll take profits, okay? And when they're taking profits, the price will retrace a little bit for new buyers to enter into the market, or or professional traders to enter more orders into the market. So the uptrend is characterized by higher highs and higher lows, and you'll see an impulse movement, retrace, impulse, retracement, impulse, retracement, impulse, retracement. And as this is happening, what we're looking for is we are looking to get in on the impulse movements, because the impulse movements they offer the best reward, because this is where the institutions are entering. And then secondly, they're less risky. So on an uptrend, we are looking to buy when price retraces. So if there's an impulse here, we're looking to buy when price retraces back here, and we're looking to time our entry to get into the market when on the next impulse. And we were looking for a retracement, and then we want to get into the market when the next impulse happens. I've had days where I literally traded for maybe about 4 or 5 weeks, and all I did was trade the uptrend, waited for the pullbacks or the retracements, and got into position and made a lot of money just going with the trend. So this is what the uptrend is. Now, the downtrend is a series of lower lows and lower highs. Lower lows, lower high. Lower low, lower high. Lower low, lower high. This is an abstract representation of it, but this is from GBP JPY. Okay. So if you see there's a low, price comes up for the retracement and then the impulse down. Lower high here, down. Okay. Market sells down. Comes back up here, market sells again, lower low. Comes back here, lower high, market sells, lower low. Okay. So likewise, like the uptrend, when the market is downtrending, you have impulse and retracement as well. The impulse move is the powerful move down. Okay. That's where we want to be selling. And the retracement is the move back or the correction. Okay. People are taking profits. Professional traders are taking profits or waiting for the market to come back up to get into a better price. So you have a series of lower highs here, lower low, lower high, lower low, lower high. So the impulse is down, then the retracement. Impulse is down, then the retracement. Impulse is down, then the retracement. So what we're trying to do in the downtrend, remember, the way that we will make money with our system is by trading with the big fish. Once the institutions trigger the downtrend, once they start selling off, we don't want to be trying to enter counter. We don't want to be trying to buy against them because the greater move, the more profitable move is down in the downtrend. It's less risky. So when price creates a lower low based off of market structure, we're expecting a lower high somewhere here. So we're looking to sell here with the impulse move down, the strong move down. Then when price retraces, it creates a lower high. We're looking to sell again here. Okay. Price comes back up to form another lower high. We're looking to sell. And we're going to do this as long as there are lower lows and lower highs being created. I've literally sold US 30 for a month or two, just waiting on the retrace to happen and entering when there's a lower high. I made a lot of money. New traders often cannot be patient and wait for the retracement to happen. So they get into the buy, which is more risky, which you don't necessarily know how far this buy is going to go. So often what happens is maybe they enter into a buy and there's some aggressive sellers coming into the market and they get stopped out when they should have just waited. Say if price is down here, just wait for it to come back up here. Don't get into the buy, wait for it to come here and sell. This is an edge in itself, trading with the trend. Now let's talk about the range. Some call it the sideways trend, is when there's a boundary above and a boundary below. Okay. Think of it like a floor in your house and the ceiling in your house. Price goes between these two ranges and doesn't break out of it. Okay. So when price is in a range like this and moving sideways, price offers us opportunity to sell at the top of the range and to buy at the bottom. So we need to know how to identify the range because sometimes, and for the most part, there's statistics that say that the market is normally ranging. And I've had times where the market was ranging for 3 weeks and I didn't have any setups. But what I want to teach you how to identify the range and trade it so that if there's time period in the market that price is ranging in, then I would like for you to have knowledge of the range and be able to trade it. Okay. So this is GJ or GBP JPY, and here it is ranging. So this is probably about a week or two, or maybe more from the 4-hour chart. So here prices comes up to this boundary, comes back down, cannot break the ceiling, comes back down, comes to the floor, goes back up, comes back to the floor, goes back up, comes here, goes down. So price is ranging here and giving us opportunity to sell here when it comes up to the boundary here, and gives us an opportunity to buy here when it comes down here. Okay. So that's the range. There's a whole lot more that we need to learn about the range and what's happening. So right now in this video, I'm just discussing helping you identify the uptrend, ranging market, and the choppy market. But in a later video, I'm going to explain what's happening, what professional traders are doing during the range. We're going to talk about the 4 market phases. So we'll see and understand what's happening during a range. We'll understand the psychology and the actions and behaviors and what's happening during an uptrend, right? We'll understand what's happening during the choppy market. So for now, we're just discussing you being able to identify, okay, the three markets, okay? So the choppy market, if you look here, there's no clear direction. It's not trending up or trending down. And then also, it's not reaching the same boundaries like as the range, okay? It's just in between, in the middle. And this is what we want to stay out of because there isn't any clear direction and any clear way for us to identify our edge. So trades taken at this point are normally very poor trades, C grade trades that we don't want to get into, we should stay out of. So we want to stay out of the choppy market trade. So if you look at this, price is just ranging in the middle here. Okay, it's just kind of choppy. We don't know any clear direction. It's not trending up or down, and then also it's not necessarily giving us a wide range of movements to the floor and the ceiling. So when you see this, you see all these doji. We're going to talk about candles in a minute and how to read candles in one of the videos right after this. But these types of candles are not very convincing. They don't give us a lot of information. So we'll talk about how to read candles in a minute, but this is a choppy market. It's not trending up or down. Now, when it comes to the trend, there are three types: the uptrend or the downtrending markets. And this is very important. This part is normally a big challenge for new traders. So I'm going to explain it here to try to help you. We hear about time frames: daily time frame, 4-hour time frame, 1-hour time frame, 15-minute, 5-minute. And we're going to discuss those time frames in a later video. But what I want you to understand about the trend is that there's what you call the long-term trend, meaning that price can be rising up. As I showed you in the first slide, price can be rising up over a long period of time. So over a few weeks, price can be going up, forming higher highs, higher lows, higher highs, higher lows. But within the long-term trend, this may be the daily trend. Within the long-term trend, you have a smaller trend that's happening on the smaller time frame. So as price is moving up, you're going to have higher highs and higher lows created when there's an uptrend, when there's an impulse. But then when there's a retracement on the longer term time frame, when you have the retracement down, the medium trend or the smaller time frame trend than this one will be downtrending. So this is very important. So you see there's an impulse. This medium trend starts to uptrend. But then once this longer time frame, longer term trend starts to retrace, as we talked about earlier in the video, then this one becomes a downtrend. Now, what can be a little bit more challenging for you and I to understand is that there is a shorter term trend, even within the medium trend, where when this trend is going up for an impulse, there is a smaller trend that's going up. And when this one is going for retracement, this trend starts to go down. And understanding this concept, that there's a longer term trend movement up, there's a medium term where as this one is going up, there's higher highs and higher lows being created on the lower time frame. And when this is going down, when the long term is going down, the medium is going into a downtrend. This is going to help us when it comes to using multiple time frames. What I mean by time frames is that this blue may be the daily time frame, this blue line. The pink here may be the 4-hour time frame, meaning that what you see when it comes to the candles on the chart is you'll see the movements printed out as 4-hour candles, okay, or 1-hour candles. So you'll be able to identify a trend with the 4-hour candles, okay, that's happening. And then even lower, if you go down to the lower time frame, when data is captured in the 15 minutes printed in 15-minute candles or 5-minute candles. Then you'll have the turquoise here where you'll see an even smaller trend. So a lot of us, we struggle when looking at the different time frames and understanding how things correlate because we don't understand this particular fact that as the longer term trend is unfolding, there are smaller trends within it. And if what we want to do is to become skilled enough to watch the longer trend and trade with it. So what that would mean is that as the blue line, the longer term, comes back for the retracement and gets ready for its impulse move, we want to look at the medium and short term trends to understand how to enter. Okay. When these trends are, there's a downtrend and then that trend becomes an uptrend. So we want to look at those shorter trends to be able to identify when they're going into an uptrend. And we're going to trade that uptrend in order to catch the big, larger move. So this is called time frame correlation. And we're going to talk about this a little bit more, but this is the abstract representation of that, okay? Long-term, medium-term, and short-term trend. Now, when it comes to the trending markets, there's something very important that we need to discuss. We need to be able to identify when the trend is reversing. As we discussed before, the market is moving in waves, moving up and moving down. So when price is moving up, we want to be buying, but price won't move up forever. Okay. Price reverses, meaning that price is doing an uptrend. And then when we say it reverses, that means that it's going to start a downtrend. So the way that we identify that, the term for that reversal is called a break of structure. So when you see higher highs, higher lows being created, there's an uptrend. What happens is one sign of the trend possibly reversing, and what gives us in our edge a high probability setup is when there's a higher high that's created and a new higher low should be created. Like you see these higher lows, a new higher low should be created. But what happens is price goes below this higher low and creates what we call a new low. And this new low is a sign that this is potentially, when it comes below this one, it breaks below this level and it breaks this higher low. And when price, we call this the new low. And when price comes back up here, this will normally not surpass this higher low over here. Okay. It may go up a little bit, but normally this is creating a lower high. Okay. For a lower low and then a lower high to start the downtrend. Okay, the downtrend structure is lower lows and lower highs, lower lows and lower highs. So this is a bread and butter situation. This is a situation that will give us opportunity to take big profits, because as we're buying here, we're buying, and then when price breaks below this one here, and creates a low high, stops here, this is a sign that we can sell here. Okay. When this low comes here, this is a sign that we should be waiting for price to come here and we should sell here. Okay. We sell here, creates a new low. We ride that one and then we wait for the impulse move, the retracement, the correction. Then we sell again. So this is key. It is important that you sit down and you draw this out for yourself. It's important that you're able to draw higher highs and higher lows yourself. And it's important that you're able to draw this concept of the break of structure. Okay. When this low comes below this low, that's the break of structure there. And then now, since we have a low low here, we should have a low high, then a low low and a low high. Okay. So that's the uptrend reversal. Now, what does the downtrend reversal look like? Okay, it's just the opposite. So on the downtrend, we have a series of lower highs, lower low, lower highs, lower low. So at this lower high here, when this goes down to create a low low, what we're expecting is for price to come about here and create another lower high and continue down. But when price rises up above this lower high, it creates what we call a new high. This high is higher than this one. It's a new high, okay? So when this new high is created, we know this is a break of structure, or it's likely to be a break of structure. So we're waiting for price to come back here to create a higher low, and we're going to buy here, and then the uptrend will possibly start. Okay, so then we should just go into buying. This is very important because as a trader who wants, as a CPT, consistently profitable trader, we need to be able to trade during the uptrend and the downtrend. We need to be able to identify when the reversals are happening, because these reversals offer us, normally offer us a great potential of a great trade in order for us to profit from. So it's very important that you're able to draw this out yourself, draw lower highs being created, and then draw out the break of structure. And then seeing this in the market as well is very important for you. This concludes our first introduction to market structure. Stay tuned. Look in the description of this video for your homework.